Bum, bum. Let's do it, folks. Good morning, one and all. Welcome to The Street today here from Post 35 on the floor of the New York Stock Exchange. Today is Tuesday, the 21st of February. What? It's February 21st? Apparently it is. I'm your host, JD Durkin. We're about an hour or so into the trading session. Stocks are trading down sharply as investors react to a whole lot of retail earnings and stronger than expected manufacturing data. We'll dive into all that and so much more. Let's take a look for what's on tap for this morning's broadcast. We will talk Fed as investors await minutes from the central bank's February meeting. We got that coming up in just a bit. Plus, we will dig into retail earnings as Home Depot and Walmart release their fourth quarter results. And finally, we'll talk Meta as the social media giant launches a new paid verification subscription. Where have I heard that before? They all just copy one another at this point. For more on these stories and so much more, we now bring in our special guest on this Tuesday morning. Ahmed Riesgo is Chief Investment Officer at Insigneo. Ahmed, good morning.
Good morning. Thank you for having me.
Absolutely. It's great to have you today for some much needed perspective on equities. Let's start there. Deep in the red after the long weekend on Wall Street. Now, historically, the day after President's Day, not really a strong one going back the last 2 decades or so. But I'm curious, what's top of mind? What are you following so far an hour or so into this shortened trading week?
Look, I think really for the past few days, the story really has been the market unwinding, taking a step back from some of these, let's say, easing of monetary policy expectations that were built into January. You're seeing strong numbers coming out of not only the United States, but especially Europe. So what we've seen is a repricing of central bank tightening expectations here. Just in the U.S., for example, we've given back roughly 70 basis points of rate cuts going into next year. To the point where at this point the market is only expecting one rate cut, and that still might be unwound here. So we still see a space where let's say multiple compression, the market sort of walking back that expectation of the Fed easing could still weigh on sentiment here and the markets for quite some time.
The Street notching its third losing week in a row. I'm curious, do you see it as the end of a bear market rally or something else?
Yeah, we actually think the market hit a bottom back in the summer of last year. And that's when the market was down roughly 25% from the peak. We don't think it's going to be a straight line or an easy line here. We still are maintaining our year-end targets for the S&P of roughly 4,100 to 4,300. We got very close to that here just a few weeks ago. Now we've given some of that back. We still expect volatility, though, to be the name of the game here throughout the year, as really we do think there will be multiple inflection points throughout the year. But like I mentioned, we do not think that we will see a retest of those lows, or at the very worst, we might see a retest of those lows, but we don't see the market breaking meaningfully lower than the lows it made last summer.
We're at 4023 as we're having this conversation. You have a base case for where you think the S&P finishes 2023?
We do, like I just mentioned, somewhere between 4,100 and 4,300 is where we see fair market value for the S&P 500.
Okay. Morgan Stanley forecasting that index could drop as much as 26% in the first half of the year. You told us your case for where you see it to the end, 41 to 43. But what does it look like in terms of volatility before we get to the end of December, I wonder?
Yeah, that's sort of the difficult landscape that investors do have to navigate, because we do think there will be volatility throughout this period. And that's largely going to be based upon this sort of back and forth that the market is doing, this song and dance that's happening between the market and the Federal Reserve, where the Fed is pushing in one direction, the market is trying to push in the other. I think we're going to end up somewhere really in the middle between these sort of two extremes. But that just means a lot of volatility between here and then.
Yeah, it's a big week ahead of us. It's only a shortened week. It's already Tuesday, which is nice, but there are a lot of important data points to follow for the few days ahead, including, of course, the Fed's preferred gauge on inflation, PCE. We love PCE Day. We get that Friday. What are some of the main economic indicators you have your eyes on, Ahmed?
Yeah, so for this week, it's really the minutes from the FOMC. We also have University of Michigan consumer confidence comes out on Friday. And like you mentioned, that PCE, every inflation data point that we get here from now over the next couple of weeks is going to be important. It's going to be something that markets and investors are going to have to keep an eye on, because ultimately that is what is going to determine what the final outcome is between this tug and pull that's happening between the market and the Fed right now.
Any PCE expectations? You want to call your shot early? What are we looking at?
Look, one thing that we've noticed is that the pandemic has really put a wrench into some of these models that we use to forecast inflation. So we feel, let's say, less conviction about the near-term outlook. However, we are pretty confident, though, that inflation is heading lower. You talked about earnings earlier. A fair message we've gotten from a lot of these management calls is that wage pressures are starting to abate in the labor market. We're starting to see that labor availability has increased, which is going to bode well for wage prices from increasing. Also, let's take a look at shelter. Everyone has been mentioning that as a really sticky point in the official government data, especially the CPI. We're seeing, though, that real-time indicators of those figures, such as Zillow.com and Apartments.com, these are high-frequency real-time indicators. Those are pointing much lower. So we think it's only a matter of time for that inflation data to actually show up in the official government statistics. When it will happen, we're not exactly sure. The road is going to be bumpy, but we're fairly confident in the medium to long-term view on that.
And at least in terms of one data point we got today, manufacturing PMI coming in a bit stronger than expected. Anything more you make of that report that we should know?
Look, that has been consistent with some of the recent releases yesterday, which is that the economy is holding in quite well, not just in the United States, but Europe. I'd like to point your attention to those European numbers, which were really quite strong, and is really showing you the underlying robustness of the recovery and of the economy, which on the one end is negative because that just means that the Fed has to stay higher for longer when it comes to rates. But on the one hand, it also means that consumers, especially with the labor market being so strong, consumers are able to hold out and continue spending, and really decreases the chances of a really hard landing here in the United States.
All right, speaking of hard landing, soft landing, no landing, as some people are now saying, let's pivot our attention and talk about the central bank. After last week's very busy week of data, what is the Fed now taking into closer consideration as we inch closer to the March meeting? It seems like it's a long way off, but you and I will be having this conversation on Fed data. It'll be here before we know it. So what are they looking at?
Certainly. Well, I think the Fed continues to keep its eye on, core measures of inflation. Now you're looking at not just core CPI, but also trim mean CPI and all these other figures, which sort of tend to strip out the outlier components. So really, they're squarely focused on that. That's what they're telling us. But also, I think more importantly, are long-term inflation expectations. That is really the key to watch here, because as long as those remain well anchored, which they have been, they've been creeped up here lately over the past couple of weeks, but relatively so, they've remained well anchored, somewhere between 2 and 2.25% for long-term inflation expectations. As long as those are there, the Fed can sort of, let's say, breathe a sigh of relief. If those sort of get unmoored, become unanchored, that's when we're in a problem, and that's where the Fed and the market is going to ratchet up its expectation of rate hikes here.
We will get Fed minutes later this week from the February FOMC meeting. You talked about it there a few moments ago. Give us your sense about what you most closely follow. What can we actually learn? We've already gotten the decision. I always get notes and tweets from people who say, what more can we actually learn from the minutes? But there is a lot of important information. So what is some of that info that we can get on a day like today, Ahmed, that we may not necessarily have gotten after Powell's last press conference when we knew the decision?
Yeah, so the most important thing to keep in mind with those minutes is really to kind of see the dispersion among Fed members. Because really, Chairman Powell, when he's speaking for the Fed as the voice of the Fed, rightfully so. But you have to remember that there's a whole series of voters within that committee that are putting in their own expectations for what the forward path for the Fed rates will be. So the minutes is a good insight into that. If we see, for example, an increase in dispersion, that could be something that could actually help the market and perhaps assail some of these rate hike expectations that are currently priced in. If we see that narrow, then we start seeing that the voices or that the Fed is starting to speak with one voice, which means that they'll be harder to dislodge from that position. So the minutes are fascinating because they're able to tell you who is saying what and who is thinking what within the committee.
Absolutely. Now, last week, speaking of, 2 Fed officials said they saw a pretty compelling case for a 50 basis point rate hike, at least not taking 50 basis points off the table. There is now, I checked this morning, I believe a 24% chance of 50 bips according to the CME Group's FedWatch tool. What do you think? What are we looking at for March? Just the trajectory of it would be strange, right? To sort of establish we were going to 25 for a while and then to kind of go back up to 50, but apparently it's more on the table this point on this Tuesday than it was a week ago.
Yeah, for sure. I think that was more a verbal intervention, to be honest, rather than an actual forward path for policy. And what they're trying to do, by the way, by verbally intervening in that way, is kind of keep those long-term inflation expectations that I mentioned earlier, trying to keep them down. But certainly 50 basis points would definitely be a surprise. I would also add this. If the Fed were actually going to do that, they would tell us beforehand. The Fed does not like to surprise the market on the day of a meeting. So they'll let us know, but so far there's no indication that the committee as a whole is generally considering raising to 50 basis points. Quite frankly, it's really not needed. Like I said, the longer term inflation data is still anchored, and the real time high frequency data on inflation is pointing down in a downward direction.
Are you in the camp of 3 consecutive 25 basis point rate hikes instead? Is that what we're looking at, and then a likely wait and see period, or how do you think this plays out?
Look, right now the market is somewhere between 5.25 to 5.50 in terms of where the terminal Fed funds rate is going to be. It really doesn't make much of a difference whether we get to 5.25 or 5.50. We're talking about 25 basis points here. Sometimes market commentators focus too much on that. What we're really talking about is really insignificant for the economy as a whole. The most important question, I think, is because we're clearly now in restrictive territory, meaning that monetary policy or the Fed funds rate is above where the neutral rate of interest is in the economy. So we are in restrictive territory where economic activity should be contained. Really, it's how long are they going to stay there, and will they overstay where they are right now? Because if they do, then that unnecessarily or could unnecessarily tip us over into a recession.
It's a good note on perspective and context in terms of, does this actually matter for the markets? I always like to remind myself, does this actually matter to someone who's watching at home? The average American family who might have kind of a loose familiarity or loose relationship with business news. I always just say, I'm not an economist, nor am I a financial advisor. If you have your credit card debt, now's a good time to pay it. That's kind of where, that's like the short answer in terms of when friends and family ask me, what does all this mean? It's like, well, if you're carrying around that credit card balance, try and pay it off. We're still seeing somewhat of a disconnect, of course, Ahmed, between Wall Street and the Fed, though between equities and bonds, there's been chatter of the two sides kind of coming closer together. Do you think we're nearing a point where we're more on the same page, or are we still in for a longer period where investors are like, they're just jawboning?
Yeah, no, I think that's a great question. I think if anything, you've seen the sort of bond market here. The 10-year of the U.S. Treasury is sitting at close to 3.9% today. So you've seen a repricing in the bond market. The interesting point, I think, from an investment standpoint, is that repricing in the bond market has not really impacted equities all that much. If this repricing would have happened last year, for example, the equity market would probably be down somewhere 6, 7, 8% over the past couple of days. That has not been the case right now, and part of that is due to the fact that the market is not nearly as expensive as it was going into the beginning of last year.
Yeah, just taking a look right now, the S&P is at 40.30, so we're still down over 1% or so. We'll continue to follow how the indexes sell off on the day. Let's talk earnings, if we can. Two big retail names. We had Home Depot and Walmart kicking things off. I do want to start with the former. Home Depot missing on revenue expectations. That's the first time the company's done so since November of 2019, and then reported a muted outlook for the remainder of the year. What else did we learn from the folks over at HD?
Look, we saw sales and EPS were relatively in line with expectations when it comes to Home Depot, but it really is all about the outlook here, okay? So that is really what investors are focused on, because remember, expectations going into this fourth quarter earnings season were already quite low. So the fact that they're meeting them is not so much of a big deal. We're seeing the top line coming in line again. That's a theme that we've seen throughout. It's really all about the guidance, but Home Depot's guidance seems to be more specifically something idiosyncratic to the stock itself, whereas with Walmart, for example, which I'm sure we're going to talk to you about right now, that doesn't seem to be the case.
So let's talk Walmart. See this? I knew we'd be a good team. It's the first day we're doing an interview together, but you teamed me up perfectly here, my man. Before the bell, we did hear from Walmart, beat it on earnings, but also giving weaker than expected outlook for 2023. How did that retailer do?
Yeah, so it's pretty much the same story here. We came in relatively in line, both on the earnings side and revenue side. So you're sort of seeing a continuation of that theme that we discussed earlier. But what we're seeing with Walmart here is that their guidance came in much lower than what expectations were. So that is something that actually might weigh on that on that retailer a bit more.
Do you expect that this next year will be as brutal as a lot of these companies are forecasting now? Or for viewers who are watching, what should they make as they hear some of these muted forecasts for the year ahead?
Look, what we've seen though is that the U.S. consumer is still there. They're still a player. They still have a role here. And the reason for that is because they still have a job. They still have jobs there, and jobs are still aplenty.
Mm-hmm.
As long as the labor market is intact or is as robust as it is, consumers will spend. We've seen this time and time again over time. So some of the more dire predictions for what would happen to both the labor market and the economy are certainly not happening, although the outlook is muted. But there is a difference between slow and slowing growth and outright economic contraction. And it seems that the latter, outright economic contraction, is being pushed out further and further away.
Sounds grim, but it also sounds as if we need to see that 3.4 figure start to come higher, at least in the view of Mr. Powell, correct?
Yeah, correct. Yeah, look, the Fed is telling you that they want to get inflation back to 2%. We know what will get inflation back down to 2% in a few months. The Fed just raises the Fed funds rate to around 9% or so, based upon some Taylor rule estimate. We'll get to 2% inflation, but the cost of that will be a severe recession in the United States. So the Fed is trying to really sort of thread that needle, which is obviously a very difficult one to do, where you slow the U.S. economy enough that you can bring down inflation in a sustainable fashion, but you don't slow it down too much to where you actually cause an economic contraction and layoffs in the labor market, or mass layoffs in the labor market.
Yeah, it is an unenviable task to say the least, but it also helps underscore why we pay such close attention to every single word that the man says in his public commentary, his carefully released statements, the question and answer periods, and then, of course, his regular visits to things like the Brookings Institute and other places where he has lent his talents over his long career in Washington. Okay, let's talk general markets here for a moment, if we can. Stocks continue to remain in the territory that we've seen them in. Do you view this as a good buying opportunity, Ahmed, for people wondering, where's the dip? I know you talked about the lows last summer, but people want to know what's ahead.
Look, I think when we speak about the market, I think we need to sort of pull back from that, in the sense that there are some parts of the market that are attractive and are definitely worth buying on the dips. Other sectors, not so much. Like, we hear a lot of people talking about growth and tech. Should they have bought that dip that happened? I don't think so. We actually think that we're in a long-term bear market in tech. So I would actually use rallies in the tech space and in growth as in opportunities to get out of that space or to rebalance away from that space. But there are other sectors that we do find long-term attractive. We do think that they are in bull markets, and we would use drawdowns, declines in prices, as opportunities to get into. One of those being, for example, the energy sector. We think this recent sell-off in the energy sector is definitely an attractive entry point for a sector that, even though it did very well last year, it is still undervalued versus where it should be historically. So we do think there's further upside there. So that's one sector, for example, definitely worth buying the dips.
All right, what are some of your tried and true investing tips that you are carrying into 2023?
Well, I think the most important one is recency bias, and this is a cognitive bias that we all have, but investors especially have. And what it is that they tend to overestimate recent performance or recent occurrences versus historic ones. So investors tend to think that what did really bad last year is likely to continue doing really poorly this year, and what did really well is likely to continue doing forward. And what we see is that when we fall prey to that recency bias, we lose track of really the historic performance or historic data, historic evidence. And what often that leads to is that we don't do the trade to the mean or the regression to the mean trade, which I think is a very, very valuable tool for all investors to employ.
I know you talked about some attractive sectors a short time ago. What are some of the other attractive sectors on Wall Street right now, you think?
Well, look, to us, we thought going into the year, we thought China was the most attractive equity market, and the Chinese economy would be the best performing economy in 2023. That has not changed. In fact, we continue to believe that. In fact, that thesis has only been strengthened. We continue to like opportunities outside of the United States better than in the United States. The U.S. equity market is cheaper than it was a year ago, certainly, but it's still very expensive historically versus where it should be. So you should continue to see markets outside of the United States performing relatively better, which means that when they fall, they should fall slightly less. And when they're going up, they should do slightly better until those sort of historical averages are compressed or to the point where they should be.
Absolutely. It was a fantastic conversation. My special thanks there to our special guest of the morning. Ahmed Riesgo is Chief Investment Officer at Insigneo. Ahmed, thank you.
Thank you very much. Pleasure to be here.
You got it. We'll do it again soon. All right, coming up, we'll bring you all the latest headlines that you need to know. But first, tech analyst Dan Ives spoke with my good friend Catherine Ross of TheStreet about his outlook for the tech sector in the year ahead. Take a look.
Dan, fourth quarter tech earnings were lackluster to say the least, but tech stocks are up big. What's your forward-looking outlook on the tech sector?
Look, I think a lot of bad news is baked in. And I think what you're seeing are some stabilization on enterprise and consumer trends. That's really been the big trend in tech earnings. Look, we believe, going into this year, tech stocks are going to be up 20%. Clearly, we've seen huge move coming out of the gate. I think it's just starting. I think there's a risk on. We'll clearly see some choppiness, but we're bullish on tech going into this year despite the dark storm clouds.
Well, do you think that this makes it a buying opportunity then?
Look, I think it's high quality tech you really need to look at. Names like Apple, Microsoft, Salesforce, cybersecurity names like Palo Alto. I think profitless tech will continue to sort of sell off. But I think that's really what I view as differentiating in this market, the types of tech names you want to own, because it's clearly going to be, I view as a fork in the road across the sector.
All right, thank you there to Catherine Ross and Dan Ives. Now get you caught up on some of the biggest stories that we are following for you at TheStreet, and we kick things off with Meta. Facebook and Instagram users will soon be able to pay for a verified profile as Mark Zuckerberg takes a page right out of Elon Musk's book. I knew that sounded familiar. Over the weekend, Meta announced the upcoming launch of a new paid verification subscription service called Meta Verified, which would guarantee users a blue verification badge. The service, which will begin testing in Australia this week, will set users back $11.99 a month on the web and $14.99 a month on iOS. In addition to the check mark, verified users will receive more protection against impersonating accounts, increased visibility in areas such as search and recommendations, and more direct access to customer support. According to Mr. Zuckerberg, the new feature is about, quote, increasing authenticity and security across our services, end quote. But let's be honest, we all know what this really is. It's about making more money. All right, on to our next story. Amazon's steep stock drop may soon start to eat into the paychecks of Amazon employees themselves, this according to the Wall Street Journal. Amazon pays a large chunk of their employees' salaries in restricted stock units, and so the recent decline in the company's stock price is likely to result in significant pay cuts. According to the Journal, corporate workers are likely to be paid between 15 and 50% less than the company's projected salary targets. Over the past year alone, Amazon shares have fallen over 35% amid a broader slowdown in the tech sector. And finally, United and several corporate partners are making a massive push towards sustainability as the broader industry looks towards a decarbonized future. Am I the only one who thinks we use the word sustainability all the time and very few people know what it means? Maybe it's just me. With investments from names like GE and Boeing, United Airlines is launching a venture capital fund to invest in up-and-coming firms developing sustainable aviation fuel. In case you're curious, sustainable aviation fuel is currently viewed as the industry's leading option for cutting its carbon footprint and comes from a number of sources, including used cooking oil and agricultural waste. United also announced plans to start displaying emissions estimates for any given flight on its website. That's going to do it, my friends, for TheStreet today. Thank you once again to our very special guest, Ahmed Riesgo, Chief Investment Officer at Insigneo, for taking the time to join us on this Tuesday morning. Stick with TheStreet.com for more on these and all of the major market stories that matter to you, and we will see you tomorrow.